Welcome back once again to CBSE Board Economics. I'm Saddam Hussain. Today we'll be discussing market price in national income accounting. What exactly is market price? Market price, the simple formula is factor cost plus net indirect taxes. In the last video, you have seen what exactly is factor cost. I repeat once again. To produce a commodity, the firm has to use the four factors of production, which are these: land, labor, capital, and entrepreneurship. Without this, the firm cannot produce anything. Land, labor, capital, entrepreneurship. These are called four factors of production. Hence, we discussed it last time. The firm has to remunerate, the firm has to pay to these four factors of production for their productive services in terms of rent to land, wages and salaries to labor, interest to the capital, and profits to the entrepreneurship. So factor cost is equal to wages and salaries plus rent plus interest plus profit. What exactly is market price now? When the commodity goes into the market, the government imposes indirect taxes on it, maybe GST. We all know that. Not only that, on some commodities, the government provides subsidies. So we have already seen in one of these videos, NIT, net indirect taxes, is the difference between indirect taxes and subsidies. NIT is equal to IT minus subsidies. What exactly is market price? You can see it here. Market price is equal to factor cost FC plus NIT. Market price is equal to factor cost. So to the factor cost, you add indirect taxes. And if the government has given you subsidies, you subtract them, you get the market price of the commodity. Now, how do you define market price? Market price is the price of the commodity in the market. That means it includes factor cost plus indirect taxes minus subsidies. We take the net value NIT. Factor cost plus NIT will be market price. Market price is the price of the commodity in the market. Now we have 2-3 small questions relating to this. Can factor cost be equal to market price? Yes, of course. Factor cost can be equal to market price when NIT is 0, net indirect taxes are 0. Or in other words, we can say when indirect taxes are equal to subsidies. Suppose the government has imposed 10% tax on the commodity and given you 10% subsidies, the net effect is 0. So hence factor cost is equal to market price. Can market price be greater than factor cost? Yes, of course. Market price can be greater than factor cost when NIT is positive. Can factor cost market price be greater than factor cost? Yes, when NIT is positive. Can factor cost is greater than market price? Yes, of course, when NIT is negative. That means subsidies are more than indirect taxes. We recollect once again what exactly is factor cost. To produce a commodity, the firm uses the four factors of production: land, labor, capital, and entrepreneurship. So the firm has to pay them rent to land, wages and salaries to labor, interest to the capital, and profits to the entrepreneurship. That is called factor cost. Factor cost is equal to rent plus interest plus profits plus compensation of employees or wages and salaries. Sorry. If you add NIT to the factor cost, we get market price of the commodity. Market price and factor cost can be equal when NIT is 0. Market price will be greater than factor cost when NIT is positive. Market price is less than factor cost when NIT is negative. That's all we have time for this short video. Till we meet next time, goodbye. Don't forget to subscribe, share, and like all the videos. Goodbye.